Hey everybody, Economic Ninja here. I hope you're doing good. I'm in some undisclosed location here, so let's not say too much. We're going to talk about a couple different things, guys. We're going to talk about the PPI today going up and actually blowing away Wall Street expectations. It was worse than they were expecting. And we're going to talk about the relationship between CPI and PPI. But we're also going to talk later in the video about the relationship to what the bond market is doing, how banks are bringing up mortgage rates. We'll talk about my 20% mortgage call when I'm talking about, I believe we're going to see 20% on the high end of this next interest rate cycle. And we're going to talk about how the Fed has no control over that, which will blow a lot of people away. Okay, so without further ado, we're going to talk about the PPI. So this is out of CNBC. Wholesale prices rise 1% in January, up near record 9.7% over the past year. Okay, just a couple little points, and I'll put this down. It says the producer price index, which measures wholesale prices, rose 1% in January and 9.7% for the 12-month period, the latter just off of a record high. It says core PPI rose right under 1% at 0.9%. Both increases were at least double the Wall Street estimates. That's gnarly. All right, manufacturing in New York region increased modestly in February, but was below expectations. The prices received index soared to a record high. Let me explain something here. PPI, the wholesale inflation measurement tool, means that wholesale prices went up. Now, in this article, they cite, and I'm going to link it below, they cite a few factors, but one really being inflation. Inflation's causing inflation now, okay? The raw materials, goods, services, pay, all kinds of stuff is going up. These companies are having to pay more to produce the goods wholesale to get them to stores. So ironically now, this is that self-fulfilling prophecy, right? As this thing starts to wind up and get bigger and bigger, right? Just like when people are saying, hey, prices are going up, I've got to get paid more. Well, as companies got to pay them more, they got to raise the prices, right? What's going to happen is you are seeing a hint, a glimpse into the future 30 days from now. And that is that inflation numbers on the CPI, cost price index, is going to be even higher. Okay, now it doesn't mean if the PPI goes up 1% that is going to equate to a 1% rise in inflation. I honestly hope we don't see that much. But what happens is it takes some time for these wholesalers to push the price on to the stores that they sell them to, and then the stores push them off to the consumer. But I can tell you this, from December's numbers, these are slowly translating to the end user, and they always end up at the end user's lap, in their pocketbook, okay? That means that we're going to see higher inflation next month, okay? Now, I want to explain something. The Federal Reserve is doing something very well, and that is called nothing, all right? A lot of people think, and I've said this before, the Federal Reserve is losing control, they've lost control, and people go, you have no idea, they're the big boys in the room, they know what they're doing. No, they haven't, okay? They are being shown as very weak and incompetent right now. If they weren't, they would not have this high of inflation, all right? They have always stated for years and years, we are planning on, our goal is to keep inflation at or around 2%. Well, guess what? They blew right past that thing, right as they were trying to get up to it. And remember, for years, guys, they had a very, very hard time getting up to 2%. And then when it happened, it's like, boom, shot right past that mark. So the facts are, the Fed has lost control. Now, another thing, too, is in December, if you remember, the Federal Reserve made an announcement, it's time. Inflation is rising. It's becoming a persistent, thing. Remember, too, the famous, it's transitory. That was all a joke. He was wrong on that, too. Trust me, Jerome Powell doesn't want to constantly be made to be wrong, and he's doing a pretty good job of it right now. So in December, he came out and he said, hey, inflation something, so you know what we're going to do? We're going to do something in 3 months from now. Well, that's pretty dumb. So instead of doing something right away, and yes, I get it, they tapered their asset purchases. They pulled back a little bit, and there was a taper tantrum. But they didn't raise rates, and they said they're going to do it in March. And then we hear about a emergency meeting that was being held, and then I don't even think that even happened now at this point. And the facts are they are losing control. I do not see a emergency rate hike coming now before March, but I could be wrong on that. But the point is that inflation is getting worse and worse. And what's going to happen is it gets worse and worse. And we're talking about compounding worse, right? And if this is scaring some people, because I know that the truth really scares a lot of people these days, they're having a hard time dealing with the truth. There are probably safe spaces somewhere. There's none in here, but there's probably somewhere around, and you guys can watch photos, videos of cats. They're amazing, especially when you take a laser and you know, into the wall. Point being is this, the truth is that these compounding issues are getting worse and worse. And as inflation gets worse, you're going to see more companies go out of business. All right. Now, I promised you that I was going to talk about inflation when it comes to the mortgage rates. Now, this is something that I believe is very misunderstood. I was looking at mortgage rates on the 30-year fixed about, earlier today, and you could get around a 3% mortgage, pretty much 3% flat, 30-year fixed conforming loan, right? Government-backed conforming loan for a home, 3% about the first week of December, maybe last week of November, around there, okay? I don't have the chart in front of me, so don't quote me on that, but around then. Today, Google's coming out with right now, we're sitting with no points, we're sitting around 4.5%. That means the interest rate on a mortgage has increased 50% in about, fasten into math, 10 weeks. That is, in my opinion, going back to when I was, as far back as when I started buying real estate, 20 years ago, 21 years ago, is the fastest increase on a percentage basis, all right, total percentage of your costs, your interest rate costs, not the actual interest rate, okay, in history in the last 21 years. Okay, I've never seen it go up that much that fast. I could be wrong, but again, I'm talking about the difference between 3% and 4.5%, which equates to a 50% increase in the costs of being able to buy a house when it comes to the interest. Now, I keep sort of talking over in circles, but it's because I really want to get this through to people, because so many people do not understand this. I get comments all the time like, the Fed is in control, they know what they're doing. They're in control. They're not. And this is why. Let me give you an example. In the last 10 weeks, have you seen the federal fund? Oh, and here's the other comment I get all the time. The Fed can't raise rates. They won't raise rates. That means mortgages are not going up. I said, okay. Have you seen the Federal Reserve, the Fed funds rate, which is currently at 0? I think it's here 0 still, maybe like a fraction above. At 0, let's say. Have you seen it go up in the last 10 weeks? The answer is no, you have not. Yet, mortgage interest has gone up. Now, this is why. Two things. The 10-year bond. Even though mortgages are not directly correlated to the 10-year bond, there are a handful of metrics that like to follow the 10-year because of the frequency in which people refi or sell their home. But what is happening is banks are directly raising their rates. This is a sign that the banks believe that they do not have faith that the real estate market is going to continue to rise. So they are asking for a higher rate. Now, check this out. On top of that, the amount of points that they are asking for now, if you want anything less than that 4.5, 4.3% mortgage right now, and you go on all the big boys, Rocket, LendingTree, all those guys, right? They're going to start advertising, well, hey, you don't have to pay that much. You could pay a little bit less, but it's going to cost you almost 2 points. That means they want as much money in their pockets at closing to do that loan. That is showing that they are not trusting of the real estate market. This brings me back to 2019 in September, when the interbank lending rate exploded because banks didn't trust other banks to loan them money overnight while they settled their debts, okay? That's why you turn off your cell phone when you start videos. Point being is this. Many people have a very hard time believing that mortgage rates are going to continue to climb. Yet we saw this in two different ways in 2004, 2005, because not only did the Fed have a dot plot plan where they incrementally raised rates about 25 basis points at a time every, let's say, 90 days, if my memory serves me right. It was probably a little bit less than that sometimes. And one time they actually did a 50 basis point hike. But on top of that, banks were becoming more and more weary, especially coming into 2005, that the mortgage market was going to stay strong, and that the real estate market was going to stay strong, and that prices were going to keep going up and sales were going to continue. And so they started charging more and asking for points. Now, we're going to go back one more time too, back into 2005. It's very important. As inventory collapses, which we are in right now, inventory is at a record low, okay? It has been for about a year and a half, 2 years. And it's gone through a couple fluctuations. It's exploded. Really, I think we hit the lowest inventory numbers were in last May, last springtime going into June, okay? Whenever that happens, the banks are looking at this and going, this can't be sustainable, because what's happening is the fear index, that gut feeling in most homeowners' minds is going through, and they're going, I don't have the money to move up and out or out and up, right, in life. So let's just fix up what we have. We saw this in 2004, 2005 when Lowe's numbers, Home Depot numbers, all these different home do-it centers, their earnings were just blowout earnings also, because people were at home fixing up their homes because they couldn't afford to leave. All right. You also see sort of a surge in pool building. That's a whole nother video. So I wanted to give you guys that explanation, and then we're going to touch lastly on the 20% mortgage rate. So many people think that that can never happen because we printed so much money and the government would default, okay? I want you to understand this. I'm talking about mortgages, not the Fed funds rate. Mortgages can do all kinds of crazy things. If a bank does not want to loan money at a certain rate, but they'll loan it at a higher rate, they're going to do that, okay? And only the foolish people that will dive into those higher rates will do it. Now, the good thing about higher rates on mortgages is it does mellow out the markets. It actually mellows them out a lot. Now, of course, we can't do what Paul Volcker did in 1980-81 because there is so much debt on the books. Quite frankly, if it was my opinion, and this isn't financial advice, I'm not a professional, but I'd be shocked if the federal government could even do anything with an interest rate, a Fed funds rate at around 1 to 2% at this point. As a matter of fact, I think 1.5 would completely break the back of the government. They wouldn't even be able to afford to borrow money that they need to just keep the wheel turning, you know, this Ponzi scheme going, and they wouldn't have enough revenue from taxes. So again, Ninja, the phone. In our live stream, all my buddies would be calling right now. So my point being is that I think it is extremely important in this day and age to understand the difference between what the Federal Reserve is doing with the Fed funds rate and what the banks are doing right now. The banks are starting to show fear. So this is a time with me, I'm just accumulating cash. I'm not selling any of my assets. I am, as my cash gets bigger, I am putting it into inflation hedges like Bitcoin, gold, and silver. But I'm also keeping a core cash position because during a crash and during panic or a deleveraging or deflation, that's when you can get some amazing deals, okay? So just because we're going through inflation and we're gonna go through some transitory hyperinflation doesn't mean you get rid of all your cash, okay? All right, guys, that being said, I thank you so much. Someone obviously is trying to get a hold of me, probably my buddies. I got to get going. The Economic Ninja is out.